Those bond yields showing signs of recession. You saw how strong demand was for 10 years right now. Where should investors be putting their money? Joining me now is Mark Smith, portfolio manager at Wells Fargo Advisors. It's great to see you again, Mark. What do you think? There is an alternative to the stock market these days. Where would you put your money?
Listen, until the Fed figures out what they're doing and we see the numbers with regards to inflation and whether we're going to stop these hikes, I think a great place to hang out is in the fixed income world. I know it's boring, but right now with all this uncertainty, boring's good because, you're seeing on the short-term immunities, really nice yields. I even have clients going out in treasuries and, God forbid, CDs. It doesn't make me a dime, but CDs are paying almost 5%. So, this is a great place to hang out while we find out what the Fed's going to do. And the only way we're going to figure that out is by looking at the numbers and seeing how earnings are coming in, how inflation reports are coming back. But when I talk to my clients who own real estate, all these rate hikes haven't really affected the prices of their homes. So I think we still have some pain to go, or according to what Jay Powell said, we're going to feel some pain. And I don't think anyone's felt it. No, but I appreciate what you're saying, that to you it makes sense that people might be looking towards CDs. You may not make a dime on it, but it's kind of the honest way to put some cushion, what would you call it, into a portfolio. It's not that you don't like equities. I mean, I'm seeing here you're kind of interested in energy, maybe some of the financials as well. Is that right? Maybe it just depends on the strategy, the type of client. You don't strike me as a guy who thinks this is going to be a great year. Well, I'm just looking at what, 70% of portfolio managers are thinking recession, maybe not a deep one, but a shallow one, right? And so with that being said, what do you do with that information? Well, XLE, I think, is a great place to hide out because China is now just reopening in the last 60 days. One of the world's largest economies, largest populations. You got to believe when they're back online that energy prices should spike. And you also have to look at all the different reasons why you should own financials, right? With interest rates going up, they're one of the few sectors that continue to outperform. Their valuations really haven't come back to the degree that you'd expect, given how high rates have been. So I really like the large banks and the financials, specifically in the U.S. All right. And then finally, you said short-term munis. Any other parts of the fixed income space that you would or wouldn't be looking at? There's been a big debate about corporate credit, for instance. You just heard what Apollo said, where they're talking about the possibility for companies triggering higher defaults because of the rate reset. It just could take a couple of years for that to work through. So do you go with, mid-teens yield in some of these areas or stay away from it because we don't know how bad things could get? It's all about your risk tolerance, Kelly. But I got to tell you, if you're thinking recession, there's no way I would want to go and get high yield corporate debt. That's the first thing that's going to fall. And so if you're in the category that you don't want to take a lot of risk, you want some yield, I'd really stay on the higher quality end of things, specifically in munis. But if you got 10, 15-year time horizon, let's go. Let's load it up. All right, Mark, we'll leave it there. It's great to see you as always. Mark Smith, we appreciate it.